All right. Hello, everybody. This is Mike Rixey. I am the lead options instructor for Netpicks, and this is our options trade of the week. For those of you that were active in the markets this past week, you saw one of the most extreme environments we will ever see. I've been trading since 2002, and last week takes the cake. It was the most volatile, wild market that I have ever seen. We are seeing moves take place in a matter of minutes that normally take months to occur. I mean, things were moving so quickly last week, it was really unreal to even look at. It was a very challenging environment, and financial media jumped all over it. They were really pushing the fear side of things last week, trying to scare a lot of people out of the market, and a lot of people did end up getting out of the market. And I understand part of it. If you're a long-term investor to watch a retirement account continue to dwindle in value, that's not a fun situation. Completely understand that. As an options trader, I look at it as a massive opportunity. We are at an extreme that we can certainly take advantage of. And I want to walk you through one of the trades that I am looking at for early next week. I think there's massive opportunity in so many areas going into next week. And I'm going to take the top, what I feel to be the top opportunity going into Monday's session. I want to focus in on the volatility products. There's two volatility products that I track in my own trading. I track symbol VXX, which you'll see over on the left side of my platform. That tracks the volatility of the overall market. And then I'd like to look at one of the VIX ETFs, symbol VXX, which is what you're seeing here in the middle of the screen. That's the chart that I have popped up. Let's talk about symbol VIX here first. And I'm just going to load up. I'm going to go over to a weekly chart of the VIX. I'm going to load up the last 3 years on a weekly time frame. If we take a look here, you'll see that historically we have had some spikes in volatility. We've had movement to the upside. It doesn't matter the catalyst, but when you see the volatility spike like this, it'll typically last for a couple of days on out to a couple of weeks. And what happens after those spikes, you can see one here and one here. There's a couple of intermediate spikes at lower levels. Anytime that we've seen volatility spike, look what happens a couple days later, maybe a couple weeks later. Volatility contracts every single time. And if we go over to the right edge of the chart, you're going to see one of the biggest extremes that we've seen in decades. We had the VIX up above 75 here this past week. Just to put context around that, the VIX is normally in the 12 to 20 range. So this is an explosion to the upside. Friday, we did see the VIX start to contract. We went from over 77, we got it all the way down to 57. It's still at an extreme, but it looks to be at a near-term exhaustion point on the upside. Volatility is starting to move lower, and I expect that to continue into weeks to come. I expect the market to stay very active. I just don't expect the level of extreme that we saw last week. I think it'll be much more tradable here in the weeks to come. So my expectation on the VIX products, on the volatility products, is we are going to start contracting here over the next couple of weeks. The argument against that, I understand that this is a unique situation. If we go back historically, a lot of the spikes in the VIX have been due to financial reasons, whether it be the tech bubble bursting or the housing market collapsing. We had the financial crisis in 2008. A lot of that was numbers driven, right? It was financially driven. What we're seeing here at the moment is health related, right? It's the whole spread of the coronavirus. And the spread is pretty much out of control at this point. And there's a lot of fear because of that. This time is not different from historical spikes. Over time, whether it's fear from a health cause, a financial reason, markets will always overstate fear. They're going to price in the worst. And as people start to realize that the world is not coming to an end over the next few weeks, markets are going to start to normalize and fear will start to move lower. Now, I'm not saying this situation is not bad. People are losing their lives. It's a very serious situation. But as a trader, as a full-time trader myself, I have got to react to whatever the market throws my way. Am I looking to make money off of people losing their lives? That's not what I'm saying here. I'm saying as my livelihood depends on my trading, I've got to be able to react to whatever the market's throwing our way. So my outlook is that going forward over the next few weeks, volatility is going to start contracting. Now, how do I position myself for that? Let's talk about that now. I like to trade symbol VXX quite often. It's the VIX ETF that I've had really nice success with over the past number of years. And I tend to trade it most often when we're at extremes. We have seen both extremes over the past few years. We've seen extremes on the downside, and we're now seeing an extreme on the upside with volatility. How do I quantify that? How do I quantify the extremes? I like to use the 195-minute chart. It gives you 2 candles a day instead of 1. And one of our custom indicators is down at the bottom. It's what we call our pulse indicator. It's the red, yellow, green, and blue histogram here. I want to point your attention to the right edge of the chart where we've got a whole slew of blue bars on the pulse indicator. Those are printing blue, representing price action being above a 3 standard deviation move on the upside. In fact, we got up to a 5 standard deviation move on VXX this past week. What that means is that only less than 0.1% of all occurrences will fall outside of this range. Meaning we are at an extreme. 99.9% of all occurrences will fall below this extreme. My takeaway from that is if odds favor price action stalling out, if odds favor either a period of consolidation or a reversal, I want to put on a position that leans neutral to bearish. Why am I neutral to bearish? Because chances are the odds favor price action stalling out. Only 0.1% of all occurrences are going to fall outside of this range on the upside. It doesn't mean it's impossible. It just means it's not statistically probable. The odds favor price action stalling out or even reversing to the downside. And we already started to see that on Friday. If I go back and look historically to other examples, let me try to pull one up here. I don't know if I've got any on VXX. I mean, you can see another stretch here. We had a slew of yellow bars on the pulse indicator. Look what price action did. It represented an overbought extreme here. Price action quickly reversed to the downside. So it's very common to see this type of a pattern play itself out with either a move sideways or a move to the downside. Now, if I want to put on a trade with a bearish outlook, one way of doing that is buying the long puts. Here's the problem with that. If I go over to the trade page on VXX, and if I take a look at just buying an at-the-money put, if I did so first thing Monday morning, those at-the-money puts, the 43 puts, are trading for between $750 and $800. Those are normally trading for between $200 and $300. They are an incredibly expensive value right now because the market's pricing in the uncertainty. The market makers are pumping up the prices in these options to price in that fear. No one knows what's going to happen next. So buying a long put, not only is it expensive, but you also have to have a lot go right in your favor in order for that trade to work out. You need a big directional move to the downside. It's got to be quick. It's got to happen quickly. And it's got to be a big enough move to offset volatility contracting. A lot needs to go right there. Volatility will contract over the next few weeks to the next few months. So as that volatility contracts, the options are going to lose value. You're not going to benefit from that if you buy a long call or long put. I'm going to walk you through over the next few minutes how we can actually put on a trade that would benefit from volatility contracting. A trade that will benefit from volatility being expensive and the option values being expensive as well. So we did get an overbought extreme here on the chart. I am looking for price action to roll over to the downside. Ideally, the sooner the better. That'd be great. But if we just move sideways, we can also benefit from that as well. So here's how we do it. If I go back over to that trade page, I am going to open up the options with 34 days left to expiration. Those are the April monthly options expiring on April 17th. If I open those up, instead of buying a long put, I'm going to take a look at selling a credit spread. And we're going to come in and sell an out-of-the-money call spread. So I'm going to go to the 47 calls. Why am I going to the 47 calls? Because they have a 65% chance of closing out of the money. You can see the probability out of the money column that I have on my trade page. I like to look ideally for the options that have around a 65% chance of closing out of the money. That's typically the option that I like to sell. So I'm going to right click on those options. I'm going to go to sell and I'm going to select vertical. It's going to pop up in an order down at the bottom. I do want to sell the 47 call, but I also want to buy the 49 call at the same time. So I'm going to click on that drop down menu and switch the 48 to the 49. The reason I'm also buying the 49 call, I want this to be a risk-defined trade. I want to know what my maximum loss is right up front if I am dead wrong. In this market, you've got to define your risk. We've seen some wild and crazy moves the last couple of weeks. If we are dead wrong and the news continues to get worse, I don't want to face a large drawdown. I don't want to blow out an account because I'm taking undefined risk. I would rather give up some profit potential, which we're doing here, in exchange for lower risk. So we're selling the 47 call and we're buying the 49 call at the same time. Because we're selling this spread to open up the position, this is a neutral to bearish trade. I want ideally the stock to move lower, but I can also make money if it moves sideways as well. Let me click on the order confirmation box and let's walk through this in more detail. I am collecting, if I can get filled here, first thing Monday morning at 62 cents. That's the current price at the close on Friday. If I can get filled at 62 cents, I'm collecting $62 per spread to put the position on. That's the most I can make on the trade, regardless of what happens. If VXX continues to move to the downside and we continue to get a big move to the downside, the most I can make is $62. I'm risking $138 per spread. Let's say the VIX continues to explode. This virus continues to spread. It gets a lot worse than what everybody's expecting. The most I can lose is $138. I'm right around risk 2 to make 1. Now, I'm comfortable with that scenario because I've got 5 ways of making money on the trade. I make money if the stock moves up, down, or sideways as long as price stays below 47.62. Now, where did that break-even price come from? The 47.62 number that I'm highlighting here. That number is calculated by taking the 47 strike, the 47 option that I'm selling, and we're adding on the 62 cents that I'm collecting to put the position on. That puts the break even at 47.62. The current price of VXX is at 43.20. Okay, so I've got about a $4 and almost $4.50 cushion here where I can be dead wrong. Remember, this is a neutral to bearish position. But if we continue to move higher, it can move higher by another $4.50 before I'm really in trouble. The only move that hurts me is a big move higher. Well, we're not expecting a big move higher because we're already at an overbought extreme. Remember, from that chart, we're at a 5 standard deviation move on the upside. Less than 0.1% of all occurrences will fall outside of this range. So the only move that hurts me is a big move higher, which is statistically not probable of happening. A lot to like about this trade. So 3 different directional moves and I'm okay. Up, down, or sideways, I make money as long as the stock stays below 47.62. I make money from time decay passing. So every day that passes, these options are going to lose a little value and we benefit from that. The time decay helps us. And then the 5th way of making money is if volatility decreases. We're at a 52-week high for volatility. That level is being priced into the options. They are incredibly expensive. If volatility decreases, we can make money from that as well. So now we got 5 ways of making money on this position. I'm not tying up a ton of capital. You can put this position on with a very small account size. You're only risking $138. So now, do I need to rush to the sidelines? Be scared by the financial media? Be scared by the virus? No, you can put on a trade with less than $150 of risk, be active in the market, generate some income, even when the volatility is extreme, even when the market is making extreme moves on a daily basis. If you've got a bigger account size, if you feel more comfortable taking more risk, you can use bigger position size. You can put on 10, 20, 30 spreads. All you have to do is change the quantity. You put it on 10 times and now you've got just under $1,400 of risk. Still a reasonable trade. And again, if we're dead wrong, the most I can lose is $138 per spread. So it's a very safe way to generate a nice, consistent source of income. Does this have a home run profit potential? No. The most I can make is $62 per spread. So I'm not taking the home run profit potential, but I'm also not taking a lot of risk either. There's a fair trade-off, and this is how I tend to act in a volatile environment where there's a lot of uncertainty. This is how I stay active as a full-time trader. Now, how do I manage the position? The only way that I can collect and keep that entire $62 is if I hold the expiration. I have to hold this trade for the next 34 days. Not something I really want to do. So what I will, in many cases, do is close these trades out early when I can keep between 50 and 75% of whatever I collected. If I collect $62 or 62 cents per spread, if I can buy this thing back for between 15 and 30 cents, that would give me between 50 and 75% of my max profit. If I get filled on this trade first thing Monday morning, I'm going to place my closing order at 15 cents. So now at any point over the next 34 days, if it trades for 15 cents, I can close it out and book the profit. Not have to worry about holding the expiration, book the profit, free up the capital for the next trade. It's also a trade that has a lot less stress. I'm not going to say it's stress-free. Anytime you're active in the markets, there's going to be stress there, right? You've got money at risk. But it's one of those trades where I can set it, not have to worry about watching it all day. I can get off to other things, track other trades, help customers and so forth. Maybe it's going back to work for you, right? You can set these trades, not have to worry about them moving all over the place throughout the day and having you miss things. You can set the trade, let it work. Yeah, you can check in on it once a day, maybe a couple times a week. Not a problem. So these are the types of positions that can generate a really good source of income. For those of you that are newer to options trading, maybe with this whole virus, you're forced now all of a sudden out of the blue to be working from home, right? They're forced, your company is forcing you to work from home, which a lot of companies are doing right now, and rightfully so. So now you've got the ability, to track the markets a little bit. Maybe you're worried about your income, being interrupted here in the months to come. This is a way where we can generate an additional source of income without taking a ton of capital. We're talking about $138 of risk here per spread. We're generating another source of income, even in an uncertain market, and in a way where it's going to take you less than 10 minutes a day to take and manage this position. Okay, a lot to like about this trade, regardless of where you're at. If you're experienced, maybe you've traded options for years, maybe you're brand new. It does not matter. These are trades that you can take. Now, everything we've talked about here on VXX, you can take this and apply it on any other stock or ETF in the market. Maybe it's an individual stock. Maybe it's another ETF. We've taken a look at a neutral to bearish trade here on VXX by selling a call spread. You can do the same thing over in some of the individual stocks that are oversold and do so by selling an out-of-the-money put spread. You'd follow the same routine that we just talked about in this video. You would just flip it around and do it with the puts. Do it on the put side. So a lot to like about this type of a trade. Don't limit yourself. Don't back yourself into a corner by just trading the long calls, long puts. When you can add to your playbook, when you add in the vertical spreads like we talked about here today, this is what's going to give you more flexibility regardless of what the market's throwing your way. This is how professional traders make money consistently. They don't lock themselves into one approach. They take advantage of the flexibility that options give us. So if you have any questions on this trade next week, feel free to send me an email. I'd love to connect and walk through it with you. My email is mike@netpicks.com. We are also going to be holding a live webinar coming up on Monday at 12 o'clock Eastern. Completely free. We're not selling anything. It is completely focused on training and specifically how to handle these current markets. So I'll post a link to that webinar in the description of this video. So if you have any difficulty joining, feel free again to send me an email, mike@netpicks.com, and we'll make sure you get logged in on Monday. So I'm going to wrap this video up here. I'll be back next week. We'll continue to track this one. We'll let you know how we end up managing the trade. But again, our trade of the week is on VXX, selling an out-of-the-money call spread. So hope you found this beneficial. Enjoy the rest of your weekend, everybody. We'll talk to you here on Monday.